So gold is at a very critical level. So I'm going to break it down for you, but I want to explain to you market rhythm. So the market has a rhythm that is measured in volumes. Now, this volume is in addition to the generic volume that is brought by different market sessions, especially the collision of those sessions when you would have the Tokyo session colliding with the Sydney session, there is an increased volatility and volume. And then also when New York collides with London and then Frankfurt with the New York, there is increased volume. Now that is the generic volume in the market. But the other volume I'm talking about is the volume that appears on specific days, specific time, the periodic volume, that is the actual rhythm of the market. And the moment you understand that actual rhythm of the market in terms of volume, you're going to be profitable. The most important part about that is that you need to understand the days in which that volume appears so that you can also prepare for the days in which it doesn't appear well. So let me explain it like this. The periodic market rhythm that is measured in volume is like this. There are weeks with increased volumes, the same way there are days with increased volumes, and then there are quarters in the market with increased volume. So what you want to do as a trader is this: you need to study the days. So, for example, Monday may have volume, Tuesday may have volume. Just because Monday and Tuesday had volume, there is a tendency for volume to reduce. So when there is no volume on Monday and Tuesday, there will be volume on Wednesday. If it is not on Wednesday, Thursday, Friday, and Monday. So the moment you understand this, then you are going to position your trading well. Now, this rhythm also goes into the month. There are weeks in the month without adequate volume. Now, I give you an example. The first week of the month that we have, where we have NFP, there is increased volume in this week. So it also come the middle of the week, there is the middle of the month, there is also increased volume, and then there are certain quarters. So once you understand this rhythm of the market, that there is volume scattered in different time intervals, you're going to position yourself well to be able to trade well, especially when you understand the days in which it is not there. So let me break down gold for you so that you can understand. So this is gold on the 4-hourly time frame. Now I'm going to break it down like we've always done. Now, if you checked our last week's video, we're breaking down GBP card signal, which is here. You just come to Throne Trades on YouTube. You'll see the signal, and then this is how it played out. This is Throne Trades groups where I send the signals for free. So you can see the trade. I had sent it on 23rd of September. This is the analysis. This is what I wanted to see for me to be able to trade, for us to be able to trade. And then this is exactly how it played out, like we had stated. And then we made some about 100 pips, which was quite enough. So in the same manner, we are going to break down gold. And this is gold on the 4-hour line. You just need to understand things. Mark your highs, your lows, and then the areas of price difference. If you are not familiar with that concept, come back again to YouTube. You look for Throne, you will find the concept explained. So I'm going to break down. So let me mark the high. So this is an all-time high for us. This is the high. The market has failed to continue further up. And then we have an area of price difference. Now, if you look at this candle here, that's what I call a price difference candle, a long candle packed with pressure, meaning it can be a high volume candle for sales and then for buys. The same thing here also, this is a price difference candle. So you want to get the difference between, the difference here was the difference between this low, which was a support, and then this new high, which was created, was here. So you want to mark it like that. So the moment you mark it like that, that will also give you an impression that when the market comes here, there will be a reaction. And then market also creates another price difference. The difference between this high and then this low, which is about to arrive to this other difference, is also here. Okay. So once you've marked this, these are the areas in which you're going to look for trading opportunities. And the best way to look for trading opportunities, you can now come to your lower time frame and begin to monitor price in these areas. How do you monitor and what are you looking for? So once price reaches into this area, especially this, you begin to look for that structure where the market creates lows and then fails to create a new low and then breaks a new low. Then you can look for those patterns. An inverse head and shoulder, a double bottom, triple bottom. The same thing here, you can look for this pattern, double top, head and shoulders and all of that, you look for them here. The moment you get them, then you can trade. So these are the areas in which we want to trade. These are the areas. If all fails, then we can come look for a double top here when price reaches here, and then we trade. So this is how I want to trade gold this week. So let's see how gold plays out. And then if it plays out, I will always send them into the group. So you want to join the group, it's free, everything is free. So let's see how this trade plays out.